Hi, we're here live from CBA in Washington, D.C., and I have Matt Hrna here to join us on the podcast and talk about the inflationary pressures and market volatility that are impacting banks today. Thanks for joining us on the podcast today, Matt.
Sure thing. I'm glad to be here. Thanks for having me.
Great. Well, could you introduce yourself a little bit, talk about your background and kind of what you're doing in the banking industry right now?
Sure, absolutely. So I'm with Regions Bank. I've been there about 11 years. I have a team that sits within the consumer product team within the first line. We collaborate with the consumer bank on product design, launch, any of the credit risk related items. We work with our second line partners on things like refining credit policy, understanding impacts that may come from capital changes, and things like that, as well as understanding when we launch a new product, loss expectations, pricing, and things like that.
Great. Great. Well, I know you presented on a panel yesterday talking about similar topics, and we'd love to let our listeners kind of hear some of your thoughts that you shared with the group here at the conference. So just as you think about kind of inflationary market pressures, market volatility impacting our banks today, what are some of the key challenges facing lenders, but especially in the banking industry?
So I'll touch on three things. One of the most obvious ones is that with the rates at this level, loan demand has continued to be dampened. There really was an interesting phenomenon, though, in 2022. It's really the first year where we began to see home equity production increase. Now, rates have continued to accelerate since that point, so we've seen that slow quite a bit as well. But I think that's an interesting point that kind of proves out the concept that when customers have their first mortgage locked in at such low rates, they really just need to see record equity levels, which we've seen today, and then a slight margin above mortgage rates to choose equity. So that's really one interesting thing, although it's since declined again. Credit card is another area that's interesting, though. Transactors aren't as rate sensitive, so we continue to see robust card demand. Aside from that, loan demand remains pretty dampened across the board. Really related to that is we think about funding costs, capital deployment. So as rates continue to increase, that means that the marginal cost of funding those loans has also increased. So we have to remain prudent about where we're deploying that capital and making sure that it's profitable, that it's sound in this economic environment with a lot of uncertainty. And then since my background is credit, I have to throw in as well the credit impact.
Sure.
You can look out in the industry and see, we know a lot of stimulus from the government and other areas hit a lot of consumers in 2020. And we've been waiting on a lot of this stimulus to normalize. We're now at a point where we're seeing subprime performance deteriorate pretty rapidly. Luckily, we don't play in that space.
Sure.
But you can certainly see those excess liquidity levels normalizing in the impact to credit portfolios. So that's really a key emerging risk everyone should keep their eye on.
Yeah, I think we've seen that, and it's been kind of been interesting that the stimulus seemed relatively modest, but was really impactful to a group of people in the country. I think the interest of HELOC versus first mortgages, with how rates have changed over the past few years. What are your thoughts with what are people doing with the HELOC money? Like, are they improving their home because they don't want to move because they'd be moving and taking out a mortgage at a higher rate? Are they using it to consolidate debt? Like, do you have any insights in that, and what is kind of driving that HELOC increase that you saw?
Yeah, I think that's a great question. It's something I think the industry's been asking as a whole. What is the primary use of the HELOC, and how do we get better customer engagement to drive growth? Because we have a recipe for growth. We have record equity levels. We know it's available. To your point, home improvement would be an ideal area. But in general, we know customers are using it for all of those. We know that as in this rate environment, customers are locked into their home. They don't want to give up their low interest rate, and that provides an excellent vehicle for them to fund things like home improvement. We know a lot of customers use it as a potential rainy day fund as well. So they're just holding it out there to have that excess liquidity as they need it and have pretty low utilization. And then also, to your point, debt consolidation.
So they're running up the credit cards and then want to pay them off, and which we've certainly seen before, and sometimes ends well and sometimes doesn't. So
and HELOCs can have features too, like locking it into a term loan, which can provide for unique features for debt consolidation.
Sure. So with all the kind of ongoing economic uncertainty, and banks and people kind of in your role and in related roles have to make decisions about strategies and product going forward. Like, how do you see the current kind of economic uncertainty of what not really knowing what's next impacting how decision makers at banks are planning what 2024 and beyond looks like?
Yeah, certainly an interesting question. Well, the first thing is all the banks have risk frameworks in place for this exact reason. So we can think about our appetite overall, how we can deploy the frameworks, what kind of emerging risks we're monitoring to ensure that we're capturing those risks. We're factoring that into decisions like capital deployment. And asking questions like, given this uncertainty, is now the right time to lean into certain, possibly, let's say, non-core products? Probably not.
Sure.
And focusing more on primacy and relationship deepening.
Okay, so kind of retaining the existing customers and expanding that share of wallet and that relationship with those customers versus maybe kind of net new unknown customers that are out there.
That's right. I think we're in an environment where expanding prospecting, especially in, let's say, unsecured loan space, the personal loan space, it's probably going to be a more volatile time for that. And if you're already talking about optimizing capital and higher funding costs, I think that just leads you back to the core of primacy, relationship deepening, and focusing on those core products in a profitable way.
I'm going to kind of throw in a new question here that came up as I was thinking about it. What do you see with there's been a lot of talk, certainly with, kind of an after effect of stimulus and the student loan moratorium, repayment moratorium. And of course, the student loans have entered repayment now, but there's really no consequences for people who don't pay because they're still protected by being reported delinquent and additional collection activities, I think, and through later this year. Is that something that's kind of on your mind? How would you kind of advise banks to think about that who do play in the consumer space, even with HELOCs or things that could be impacted by someone suddenly having a large monthly payment come due that they may not be making now, which we know a lot of people are not?
Yeah, that's the big unknown right now. Because we were sitting before October when the repayment began, thinking through what those impacts might be. I would say I thought it would be a much bigger impact than we've seen. So that could be to your point that there's a 1 year on-ramp period, but it's just something we'll have to monitor closely. I think given the demographics of that population, you would certainly expect to see some uptick in unsecured loan demand, possibly some different credit card behavior. I would suggest monitoring any unsecured lines of credit to see where are those customers that have student loans, whether they have them through you, through the government, or wherever, and then monitor their performance to see what the impacts are. And also looking at their deposit levels to see how stressed they are. But as of right now, we've seen pretty minimal impacts.
And I know certainly something we talk a lot about both at our company and with partners. And I think we've all seen a lot less impact to it than maybe anticipated. And maybe that's good. And maybe we just we'll wait it out a little. So, what do you see as some tactics that banks can use as they think about navigating the current market? Like, what are some of the tools in the toolkit to deal with inflation, market volatility, deposit levels being low right now?
Well, I think the first thing is to make sure you have a recession playbook. So this is hopefully an exercise you don't have to deploy, but at least making sure you have all the players thinking through and talking through those possible scenarios and documenting what is possible or for deployment in your toolkit. And so that would involve talking through balance sheet pressures, credit pressures, when is the right time to deploy certain account management features, when is this the right time to pull out of certain areas or lean in potentially. So I think that's the first thing, having those conversations firm-wide, getting the right risk players in so that whenever the next thing does move, we have that on the shelf all those conversations have occurred. We've had the right committee approvals and governance, and they can be deployed, as opposed to scrambling.
Sure. So kind of stress testing, like where are risks, what do we see as scenarios that could happen, and making sure that you know what to do in various scenarios so you can trigger it versus figuring it out when you're already in that stress scenario.
Yeah, that's right. And I think a good example of that would be, just picking on one, would be, when would you deploy something like a credit limit decrease? Or the reverse of that, when would you be comfortable changing your strategy around credit limit increases?
Sure. So, I think there's certainly kind of the risk side of thinking about like how to worry about, different areas and different impacts of market volatility or inflation, stressing consumers or even companies that are buying consumer goods or things for their company. But I think there's certainly an opportunity for banks to think about kind of adapting and evolving. So what is next? Like not just kind of defensive, but opportunistic. What can they do? How important do you think it is for banks to be, I think if you had to kind of compare contrast, like being defensive and protecting what they do today, or really kind of adapting and evolving new long-term strategies to plan for what's next?
I think banks should be doing both. So obviously adapting for this economic environment, you want to be defensive and protect the core, focus on primacy, protect the balance sheet, et cetera. But to your point, consumers are demanding new ways to interact with the bank. And so we have to be doing both. We have to think about convenience for the customer.
Sure.
We know online and digital is a pretty big component to that. The branch network is still vital to our success, but we know that customers want that digital experience.
Sure.
And I think the other thing I've hit on a couple times now is what doesn't change. The customer focus on primacy. No matter how you interact with customers, I think that's key as well.
Yeah, it's really been interesting, I think, seeing there's, it seems like the smaller, kind of more community banks have kept their branch footprint. Some of the middle-sized banks, regionals, have reduced their branch footprint. And then when you see the largest banks actually increasing that branch footprint, which I think is super interesting to watch as the move to digital, but the branches still hold a place. And I think it's that, deepening that customer relationship and providing that place for people to get advice, because they do sometimes need in-person advice or need ways to transact. So what do you think, when you think about adapting and kind of growing for the future, maybe adding new asset classes or adding new features for consumers or internally, what role do you see the really technology providers, fintech partnerships playing in really helping banks both mitigate risks, but then also going to capitalize on new opportunities in the market?
I think there's really two roles that they play. The first is probably the most obvious, thinking about capabilities that banks don't currently have, or that may cost too much, may not have the economies of scale to deploy. So when you think about online origination channels, enhancing the application process and making it more efficient for the customer experience. So there's a lot of fintechs out there that banks can partner with today to help alleviate some of the pain points in that process. So that's one. The other, as we begin to think through, would be, you mentioned different asset classes. So are there certain asset classes that banks haven't traditionally played in, that they would like some experience and they would like to ensure that they have those guardrails up with someone who's more experienced? So when we think at Regions, as an example, a couple years ago, we partnered with SoFi and also with GreenSky to play into some new asset classes to understand what that credit performance was like.
Sure. Yeah, and it's definitely, I think, a challenge, particularly for a bank that may not have a new asset class. Like that's a big risk to take career-wise, even for the people who are kind of promoting that and being the champion internally. And I think getting it through the kind of new business initiatives committee or whatever that process looks, particularly at the larger banks, can be daunting. Do you have any, I guess, kind of words of wisdom, words of caution for a bank that may be entering a new asset class or considering it? Like, what are some of the things to look out for, some of the maybe pitfalls you've seen banks make in choosing those partnerships?
I think one of the first, that's a really good point. I think back to comparing the business models. So in most cases, you'd need to check to make sure that aligns with your own business strategy. comparing how different their credit policy might be from yours. I'll give you a really good example of that. One of the areas where we learned quite a bit was in our SoFi relationship. SoFi is well known to use a lot of machine learning, and at the time that was an area that was relatively new for us.
Sure.
And so that's something we had to get comfortable with to understand the impacts and bring through the appropriate governance channels.
Yeah, and I definitely think that being visibility, understanding of maybe model construction, model risk management,
That's right.
it
Yes.
can be a challenge because the transparency of what you have access to with different partners may be different. And but I did like what you said about, thinking about maybe complementary things, that if the bank doesn't have that core competency internally, how do you partner to bring it in versus hiring to bring it in, which can happen but can be very expensive. So I think that kind of the last question I had for you today is a little bit off topic, but kind of a hot take question. So I noticed that you worked in politics before you became a banker. So which one is more volatile as a space to be in, banking or the political arena?
Definitely the political arena.
Yeah, yeah. Did you enjoy working in politics, or was it a short-term thing that then you became a banker after and didn't look back?
So that was right after college. I've always been interested in data and analytics, and I found a niche that I could work in there to help support some of the legislative items, and really do a research and analytics role. But I don't think most people would be surprised. Politics is a relatively toxic environment. So there's a reason I'm a banker now, and I haven't really looked back.
Yeah, great. Well, good. Well, thank you. Thank you for joining us today. It's definitely been interesting to hear your take on the market, and I think there's no shortage of interesting things happening right now, both in the industry and with the regulators. So they're all of them are keeping us busy.